Everyone's living for today, and who can blame you? It's a fast-paced world with a 24/7 news cycle and an ever-changing technology landscape. While you have your head down and you're doing everything you're supposed to, working, saving, and preparing for the future, you may find that you have a huge tax liability when you get ready to retire, and the government forces you to take out RMDs, or required minimum distributions, from your qualified accounts, like your 401k and your traditional IRA. As financial advisors, it's our job to look down the road and help you plan. And you've heard a lot about Roth conversion strategies, but today we're going to talk about a different strategy to help you lower your lifetime tax bill: Qualified Charitable Distributions. Using QCDs is a great way to dodge the tax bill, just like many of our millionaire clients do.
So you may be wondering, what is a QCD?
A QCD is a Qualified Charitable Distribution that comes out of your traditional IRA and goes directly to charity. And by doing it this way, it does not hit your tax return. It's not a taxable distribution for you. You have to be at least 70 and a half years of age. The money has to come out of your traditional IRA, and it does have to go directly to the charity of your choice. In other words, it can't go to your bank account first and then you write the check to your favorite charity. It's got to go directly to the charity. As long as you do that, then the tax consequences of the distribution are not payable by you. It's a great way to help you lower the tax bill. So in order to help you understand this, can you show the audience how this works?
Yeah, let's dive in. Well, so as you mentioned earlier, as financial advisors, we want to be looking ahead to see if there's any tax consequences in the future. So what I want to do is I want to focus on the plan distributions here. And you'll notice there's a bunch of zeros all the way up until age 75. And so at 75, you can then see a large distribution coming out of their plan, and this is that required minimum distribution.
It's almost $200,000.
Almost 200. So they did a really good job, and now they're getting punished. And what I mean by that is, if we look on the right, this is net cash flow, and that first year of their required minimum distribution, they now have $74,000 over and above what they need to fund their retirement.
And the IRS is making them take out way more than they want.
They're getting taxed on those dollars. And so what we want to do is use this qualified charitable distribution, which allows us to satisfy this required distribution and lower this over time. And so let's take a look at the taxes. So what we're looking at here is the cumulative tax bill without taking the qualified charitable distributions into account. So over their lifetime, John and Jane were expected to have a cumulative tax bill of $3.3 million.
That's a lot of money they're going to be paying in taxes.
Right, and so we wanted to implement this strategy. And remember, they're charitably inclined, so their total portfolio assets down here will go down because of doing the strategy, but let me show you what it looks like. Okay, so then with us using the qualified charitable distribution strategy in the future, you can now see the cumulative tax bill for John and Jane has been reduced by $726,000.
It's almost $750,000 of taxes they're going to save.
Exactly, and you can see up here these gray bars that are popping up. That's because of the required minimum distributions not being taxable to them. It's now allowing more dollars to go to charity and then them not being taxed.
You know the old saying, do well by doing good.
Absolutely.
Really applies here. So this is a great strategy if you're charitably inclined, but Matt, what if somebody's not charitably inclined? What else can they do? Can they give money to the kids to help lower the tax bill or the RMD?
Unfortunately, no. Any dollar that's coming out of your IRA is going to be fully taxable at ordinary income at your rate, so you would be taxed, and then you could give dollars to the kids, up to $19,000 for this year.
And do those gifts to the kids, does that help lower the tax bill?
Again, no, unfortunately, no tax deduction for you for giving the $19,000 to the kids.
What about parents?
Parents, same thing.
Darn.
Darn. So one thing you could consider, though, although it's not gifting to the kids and giving you a tax deduction, we've talked about in the past Roth Conversions, which over time could lower your required minimum distribution. But even if it's not helping you a lot for tax purposes, if you wanted to give to the kids later, then they would then inherit tax-free wealth.
That's pretty nice.
Mm-hmm.
So congratulations, you've done a great job of saving and preparing for retirement. But don't let the ticking tax time bomb of large required minimum distributions make you overpay your tax bill to Uncle Sam. Use this strategy to do well by doing good, give money to charity, and help lower those required minimum distributions in the future. And if you want help on understanding these strategies or just having a plan in place for you, please feel free to get in touch with us. We're happy to help guide you.
And we're curious to know your strategy. Do you like Roth Conversions? Do you like QCDs? Do you have another idea? Please leave a comment below. We'd love to hear about it.
Make sure to like and subscribe to the channel, and we'll see you on the next one.